This show is sponsored by Lightyear, a new straightforward platform offering a stocks and shares ISA with no account, subscription or custody fees. Lightyear's stocks and shares ISA will be 10 times cheaper than the average market provider over 10 years based on research conducted by Capital Economics. And its cash ISA offers easy access to the Bank of England base rate. Both accounts are flexible so you can withdraw and reinvest without affecting your annual limit. Capital is at risk and ISA rules apply. Other fees like foreign exchange fees may apply. Lightyear UK Limited is authorised and regulated by the Financial Conduct Authority.
Hello and welcome to episode 494 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leach. Damien, welcome back. How you doing?
I'm good. It's good to be back this week, Andy, and it's also really nice to have gone back to the Renaissance Foundation. So it's the charity that we help out that's based in the City of London. So they help out young people who have maybe difficulties with their home life, and so they are helping them become, I suppose, achieve the best version of themselves that they can achieve. So they are doing things like giving them exposure to some really great opportunities with businesses, with speakers who come in, might be artwork. And one of the things that we do, we go in now every quarter and do a session in relation to money. So it could be anything to do with money. Last time we did investing. This week when we went in, we did about budgeting, and we're trying to give them tips to try and arm them with the skills that they need as they go through life. So that's really good. And it's so much fun going in because the young people who are in there have a really good sense of humour. It's obviously for them quite intimidating, I think, having people come in and give talks. Some of them have their own sort of issues that they are dealing with, but it's great to see them come out of themselves, even if it's me talking about how rubbish I am at Fortnite, because obviously I play that with my kids and they all love a bit of Fortnite. So it's really good to go and really give something back. And the reason that I mentioned it on the podcast is because I think by talking about it, hopefully some people might go and have a look at the charity and see what they do, because it's the only way that they get the support that they need if people talk about the great work that they're doing.
Yeah, it's always good to hear what you've been up to when you've been down there, Damien. And I know they've been keen to learn about podcasting, so I'm going to be coming along to one of the next sessions. And I was a hot topic when you were talking about computer games, because apparently they like FIFA.
Yeah, so last night your name did come up because we're going to be doing obviously a podcast workshop, really, to show them how easy it is to create a podcast, but also because of your FIFA prowess. So anybody who plays FIFA, I think, Andy, did you get into the top 1,000 people in the world playing FIFA at one point?
Yeah, at one point I was right up there, but I have to be honest, it was to the detriment of everyone around me, my family, my children. So I've taken a bit of a step back, and actually I'm taking a bit of a break from FIFA. So if I do end up paying some of the youngsters from the Renaissance Foundation, I'm sure they're going to probably end up beating me.
So the upshot is, Andy, the young people are desperate to play you, to test their skills against you. So moving on to what's on this week's show, the first piece I'm going to be doing is a mortgage checklist almost. So how to improve your chances of getting a mortgage. That's if you are somebody who wants to buy your first home or somebody who might be looking to remortgage. I'm going to go through all the things you need to be doing or thinking about in the lead up to actually trying to take out a mortgage in the future. The second piece I'm going to be doing is in relation to getting the best retirement income. So there are options like taking an annuity or drawdown, and there's been some great research that's been carried out as to what is the optimum combination of those types of products to achieve the best income in retirement. And the final piece, Andy, you're going to be doing something on energy.
Yeah, and so we're approaching the end of February now, and Ofgem, the energy regulator, will be providing their next update as to where the energy price cap will be for the 1st of April. And so previously we've talked on the podcast about Cornwall Insight, who do some analysis and give you some ideas on where the energy price cap will be. Well, energy providers are now analysing the data themselves and producing some pretty good predictions on where those price caps will be in the future. So I'm going to give 3 sites that listeners need to go and look at, and they can use this data now to compare it to the fixed tariffs that are on offer and say, well, is that going to be a good deal? So we've now got more tools available to us in order to predict where those prices are going to be and whether we're getting a good deal.
And the important thing is those new tools are updated weekly. So you are getting more information more regularly. So moving on to the first piece then, Andy, on mortgages. So I'm going to tell you how to improve your chances of getting a mortgage. Now, this is relevant for people who may be buying their first home, so they're getting their first mortgage, but also people who may have a mortgage already that may be looking to remortgage. Now, you have to remember that if you've got a mortgage already, one option that's always open to you is a product transfer. So you can stay with your same provider. When your mortgage deal ends, you can switch to another, for example, fixed term deal with that same provider. But you have to accept you're going to have less choice in terms of deals and the interest rates that are available. But on a positive, there will be less onerous checks. So they won't necessarily check your income like they do when you take out a mortgage with a provider for the very first time. So with the idea that you might be taking out your first mortgage or remortgaging, what should you be doing in the lead up to trying to get a mortgage? Now, you should be doing some of this stuff as far in advance as a year ahead of when you're planning to apply for a mortgage. So the first thing I want you to do is check your credit report. So you should be checking your credit report with the three main agencies out there. So Experian, Equifax and TransUnion. The reason why I say you need to check with all three agencies is because they can hold different information about your financial arrangements. Also, different mortgage lenders will check with different agencies when it comes to looking at your credit report, and they use that information to create a credit score and decide whether they're going to lend to you. Now, the information on there needs to be accurate. So when you look at the report with each agency, make sure the information is correct. If there are any errors at all on there, then do make sure that you contact the credit agency and you tell them that there are errors so they can be rectified. Now, the problem is it can take a while for any errors to be rectified. So that's why you need to do this way ahead of planning to take out a mortgage or remortgaging. And the other thing you want to check is whether there are any financial associations. They will show on your credit report. Now, that is where, for example, you may have had a joint account with an old partner, and that means that your credit reports are linked, and that can adversely impact your ability to get a mortgage if, for example, they have a very bad credit report. So you need to close those accounts if it's a joint account and make sure you contact the rating agency and tell them that you are no longer financially associated. Also, do make sure you're registered to vote. The reason you do that is positive for your credit scoring when you actually apply to a lender, but it is also used as evidence that you live where you say you do. So make sure that you're on the electoral roll. If you don't know, contact your local council. The other thing you've got to make sure you do is pay all your bills on time. Make sure you don't miss any payments because they will show up negatively on any credit report. So that can have an adverse effect if you are trying to apply for a mortgage. If you've missed payments, say on a utility bill, or it could be on another product that you've taken out. Now, missed payments are bad. They can negatively impact your credit report and any credit scoring, but defaults are worse. So if you have something like a loan, for example, and you've defaulted on it, then that is particularly negative when it comes to a lender looking at your credit report and trying to judge whether to lend you money. A county court judgment is even more severe than a default. So you don't want to have any county court judgments on your credit report. So that means that if, for example, you get parking tickets, make sure you pay them, because if you don't, then you could end up having a CCJ for something like not paying your parking tickets. They are all treated the same. So make sure you don't have anything like that on your credit report. Next, make sure you are managing your existing debt correctly. So first of all, make sure your debt levels are nowhere near your income levels. So when you go to take out a mortgage, lenders will look at something called a debt to income ratio. And it's an important metric when you do apply for a mortgage, and it compares your total monthly debt payments to your gross monthly income. Now, this ratio helps lenders assess your ability to manage monthly payments. So they will calculate that by adding up all of their monthly debt payments, which include credit card payments, loans, and even potential mortgage payments. And they divide this by your gross monthly income and multiply it by 100 to give you that percentage. Now, if your monthly debt payments are, for example, £1,500 and your gross income is £4,000, that will give you a debt to income ratio of 37.5%. Now, what lenders do is characterize you by the level of that DTI, that debt to income ratio. So if it's over 50%, then you're considered a high risk borrower, and that will mean you'll probably need to use a specialist mortgage lender. If you're between 30% and 50%, then that's acceptable to a moderate risk, and you'll generally be eligible for most standard mortgages. But if you are less than 30%, then you are deemed a good borrower and you're likely to be approved for most mortgages out there by most lenders, and you'll probably receive the best rate as well. So you want to maintain a good debt to income ratio. So make sure you calculate what that is. And if you have to, then pay down any debt with savings that you have. Now that leads on quite nicely to something called credit utilization. You need to know what your credit utilization is, and that is the percentage of your potential debt you've got access to that you are using. So if, for example, you have credit cards that give you a total of £10,000 when it comes to available credit, and you've got a balance of £5,000 on those credit cards, then you've got a credit utilization of 50%. Now, lenders prefer you to have a credit utilization of less than 50%. So maybe aim for something like 30%. So the message is avoid using all of your available credit if you're looking to get a mortgage in the future. Now, there'll be some of you that have old credit cards that you're not using that are effectively inactive, but there is available credit on them. And you might be thinking, well, should I just close them down then? Now, you have to be careful with what you do, because old accounts, whether it's a current account or a credit card, they are actually positive for your credit report because it shows you've had a relationship with a lender or bank for an extended period of time. I understand that people have inactive credit cards and they worry that someone might get hold of the details and spend on that card. That is obviously a valid concern. So you need to keep an eye on these accounts even if you're not using them. But do be careful, because if you close them, not only could you be getting rid of an old account that could be positive for your credit report, but you could change your credit utilization. So if you closed all of your available credit lines down to your level of credit you're using, just your one credit card, then you are actually increasing your credit utilization ratio. So that can be negative. So be careful of that. The other thing I want to mention, car finance. So car finance eats away at your monthly income. It can be a sizable chunk, a few £100s. When you go and apply for a mortgage, they will assess your outgoings. And obviously your car repayments will form a sizable chunk of that. And that could limit the amount of money that they will lend to you. So what's better to do is to own a car outright, so you don't have any loan payments or finance payments going out for that car that can count against you when you apply for a mortgage. So that means that maybe you do need a new car, but you're looking to maybe take out a mortgage in the coming year. Maybe see if you can keep the old car going for that bit longer. And then once you've got your mortgage, then you might look to take out a new car, maybe via car finance, once you've secured the mortgage. Next, avoid opening up new lines of credit, especially in the months ahead of getting a mortgage. And that's because that can negatively impact your credit scoring with a new lender. So there will be hard searches done on your credit report, which will show up, and that could negatively impact your chances of getting a mortgage. I would also say it's not just about taking out, say, credit cards. It's also if you take out bank accounts. So if you take out a bank account that's got an associated overdraft, then the bank could do a hard credit search on you, which will show on your credit report. So I mention that because I know there are lots of people who like to switch current accounts to take advantage of incentives. Maybe hold off doing that in the lead up to trying to apply for a mortgage or remortgaging. This tip is slightly unusual because it's actually to do with social media. Now, you've got to realise that our lives are online, so be careful what you post, because lenders do potentially have the ability to go and look at what you're posting online to show you what your lifestyle's doing, or maybe some of the things you're doing in terms of if it's tax evasion. Anything that's a risk could negatively harm you when you're trying to apply for a mortgage. The other thing, you might have friends who think it's absolutely hilarious to put references in payments when they send you money, or you might be doing it to other people. Avoid doing that, because when they look at your online bank account, they will ask for statements, for example, when you apply for a mortgage. So they look at your discretionary spending and they see these strange payments. They might start to raise questions. It might just slow down your application. While we're talking about spending, do stay out of your overdraft. So a lender will look unkindly on somebody who keeps going into their overdraft each month and then comes back out of it when they get paid. It shows you're not managing debt very well. And given that they're going to lend you even more money, they could see that as a potential risk. Now, the other thing I want you to do is look at your direct debits and standing orders on your account. So you want to keep all financial commitments down. Go and look at your online banking, list all your direct debits and standing orders, and see if there are things on there that you can get rid of. Because when you apply for a mortgage, the lender will ask to see your bank statements and what you're spending your money on, because they use that to assess how much income have you really got to service the mortgage that you want to take out. So you want to get rid of unnecessary direct debits. If you can afford to, try to pay for services annually rather than monthly, because that removes that commitment. So whether it's something like Disney Plus or insurances, paying annually is cheaper, but when it comes to insurances, it also removes that element of credit agreement that actually exists when you're taking out an insurance policy with a provider. Because when you take out insurance, if you take it out annually, they will only do a soft check on your credit file. But if you take out a monthly policy, so you're paying premiums monthly, they'll actually do a hard credit search on your credit file. It will show on there for when the lender looks at it. So if you can, try and readjust your finances so you have very few direct debits and payments going out. The lender won't look for a whole year's worth of bank statements. They'll look for about 3 months worth. Now, obviously, once you've done that cleanup, you have to bear in mind that lenders can still make a judgment call for an assessment about how much you might be paying for certain things that aren't necessarily showing in your personal finances. So you can't get rid of everything and say to the lender, look, I'm not spending any money, because they are realistic. They will know what people generally spend on certain things, and they can factor that into your own mortgage application. Next, which is kind of obvious, if you are going to be taking out a mortgage for the first time, then you want to save as much as you can for a deposit, because that will mean that you will get the best deals and you'll get the lower rate. So if you've got a high loan to value, you tend to pay more interest than somebody who's got a low loan to value. So the bigger the deposit, the better the deal that you normally get. And so if you are somebody who's remortgaging, then you might want to consider overpaying your mortgage ahead of a remortgage if you want to change lenders. So that normally means there are limits. So you can normally only pay 10% a year of the balance of your mortgage without incurring a penalty, but it's something to think about. People ask about pensions. Well, workplace pension contributions don't tend to have an impact when it comes to the assessment for a mortgage. But if you are self-employed, for example, and you are paying into a private pension, then that can impact affordability. Talking of employment, staying in the same job can be positive when it comes to applying for a mortgage, because they want to see reliable sources of income. So a history of employment is positive. That doesn't mean if you are going to change jobs ahead of an application, it's necessarily going to be a negative thing, but they will write to your employer and ask for evidence that you have got a job there, because they will usually ask for the last 3 to 6 months worth of pay slips. So this means you need to make sure you've got those when you're going to apply for a mortgage. Now, some lenders, like I said, will accept job contracts if you've got a new job you started in the last few months. So it's not necessarily bad if you switch jobs, but do bear that in mind. But the main thing is, do keep a reliable history of any earnings that you have. So that's pay slips, that's also things like P60s, but also bank statements, because you want to show that the money going in your bank account is the same as what it says on your pay slip. For self-employed people, it's a little bit more complicated. So you're probably going to need to provide tax returns, maybe an SA 302 form, or you may even have to provide some accounts from your business. So it could be at least 2 years worth of accounts. Some lenders do accept 1 year's worth of accounts. If you are a limited company director, some lenders will use your salary and dividends from tax calculations, while others will use your salary and a share of the company's profit, so your share of the net profit, when they're looking at any assessment of whether to lend to you. So make sure that you know these figures in advance. And obviously, if you are somebody who is maybe a company director and you obviously can have a say over how much you get paid, you need to bear that in mind, because you need to have enough earnings for the last few years, for example, when you're applying for a mortgage to get the mortgage that you want, because lenders typically use something like 4 to 5 times income multiples when they're working out how much to lend you. So make sure the numbers do stack up. If you've got a side hustle, then that can be used as income in a mortgage assessment if you pay tax on it. If you don't, then obviously you can use the money for your deposit. Now, that is actually an interesting point. When it comes to evidence, you need to make sure you've got evidence of where your deposit has come from, because they will want to know where the money's come from for money laundering purposes. So make sure you've got statements and paperwork to show where it came from, if it's a gift, for example, from your parents. That leads on nicely to the next point, which is about keeping your paperwork in order. So make sure you've got pay slips, make sure you've got the relevant bank statements that go back, make sure you've got credit card bills and utility bills, which can help be used as proof of address, driving licenses, passports. All of those things will be useful when you're applying for a mortgage, and you can give them to your mortgage broker, something I'll come on to in a second. Perhaps a wider point, it's a good time to build a budget and sticking to it, because then you can ensure that your finances are in the best shape when a lender looks at them, so you manage your discretionary spending. Probably the biggest tip I can give you is to make sure you speak to a mortgage advisor early. So a mortgage advisor can help you get the very best deals out there when it comes to a mortgage. Not all mortgage deals are available direct to customers, so they could help you get a better deal, but they can also help you get accepted on a mortgage. So if, for example, a lender was being a little bit difficult, they can speak to that lender and give further evidence in your favour. So I would say to people, particularly if your circumstances are a little bit unusual, maybe you're self-employed, there's nothing wrong with speaking to a mortgage broker a year ahead of time. So go and see that mortgage advisor, and they can tell you how your finances are shaping up, what are your chances of getting a mortgage, what size mortgage you could get. Now, if you don't know a mortgage advisor that you trust, then there's a link in the notes of this show where you can find a reputable mortgage advisor, and actually you can get a mortgage review. The other thing a mortgage advisor will do is actually give you a wide range of options and discuss all of the different types of mortgages that exist out there and which one could be the best one for you. Not only can mortgage advisors tell you about the things you might need to change in your circumstances to increase your chances of getting a mortgage, but they can also tell you about changes in trends that are going on in the mortgage market, about what lenders are looking for. So things do change over time, so you can make sure that you are getting your finances in the right order for when you do eventually apply. And perhaps the final point I just want to mention is don't lie. The worst thing you can do is lie on an application, because not only is that fraud, but if you're talking to a mortgage advisor and you don't give them all the information that they need, they're on your side, then you will end up finding you could get rejected, and you don't want to get needlessly rejected. You apply for a mortgage and you get turned down, there will be a hard credit check on your report. So you want to limit the number of applications you are making. So be truthful with your mortgage advisor, because they can help you. Don't need to keep applying. If you do get rejected for a mortgage, then you need to look at why. And if you've got a mortgage advisor, they can explain to you why you got rejected and then can find better alternatives. Or it could be, for example, the lender's made a mistake and they can go back and argue your case.
Okay, so let's move on to the next piece of the podcast. Then we're talking about pensions, and specifically pension income. And so, Damien, you're going to be looking at the different options people can use in order to maximise their pension income.
So when you get to retirement and you've got a defined contribution pension, you've got a decision to make when it comes to taking an income. Do you use annuities, or do you use drawdown, for example, to try and provide the best and maximum income throughout that retirement? Now, just as a reminder, an annuity is where you take your pot of money and you'll give it to an insurance company, for example, and in return, they will give you a promise of a guaranteed income for the rest of your life. Now, there can be different versions of annuities. You can add on, for example, guarantee periods. You can have joint annuities, so it will pay out an income to a partner if you die. Is you give your money over to the insurance company, and in return, you receive this guaranteed income. The other option is drawdown, where you can use your pension pot flexibly and you can draw income from it when you need to, but you can also keep most of it invested in the market so it can grow. Of course, there is investment risk with that. Now, the reason why this is particularly relevant now is because annuity sales have been surging. So in the last year, the number of annuity sales have actually risen 24%. That's a 10-year high. And now the increase is largely down to annuity rates, and that's because they've been rising. So annuities are still one of the best ways to get the maximum income from a retirement pot. Now, just to give you a sense of how much annuity rates have risen, if you go back to 2022, a 65-year-old with 100 grand would have received about £4,540 a year, assuming they took a level annuity. So the income wasn't increasing year on year in line with inflation or anything like that. And there was no guarantee period. So basically, when they died, the income stopped. Now, a 65-year-old today would actually get an annuity rate of 7.54%, which means that if they had £100,000, they would get £7,540 today. That's a massive jump. And the reason that has happened is partly because we've seen gilt yields rise. So annuities are clearly becoming much more attractive to people today. So what do people do? Do they take an annuity for that income, or is it drawdown? Because you've got that flexibility that you get with drawdown, but there's also that investment risk. Well, it's not an either or decision. And what I want to talk through is some analysis that's been carried out by Standard Life. And what they did is they looked at 3 different scenarios. So somebody who's age 65, and they compared the outcome if they had £150,000 pot of money in their pension, and they did one of 3 things. The first one was the traditional level annuity. So this involved the person using their entire pension pot at age 65 to purchase a level annuity. Now, this provides a fixed income for life, meaning you know exactly what you're going to get. And in the case of somebody who had a £150,000 pot of money, the level annuity that Standard Life worked out that they would get roughly, based on typical annuity rates, was £10,151 a year. Now, that comes to a total income when you get to age 90 of having received £253,775. So a large sum, assuming that you actually made it to age 90. Now, this approach obviously eliminates all investment risk and your payments are guaranteed, but there are significant downsides. So firstly, inflation's the biggest one, because inflation significantly reduces the buying power of any income you get each year. And secondly, you miss out on the potential improvement in annuity rates that may occur as you get older, because the older you are, the better the annuity rate you get, because obviously when the insurance company factors in your life expectancy, they'll pay you a bit more money because you're not actually expected to live as long. And the most important thing of all is that once you've bought your annuity, so a level annuity, you lose a great deal of flexibility with this particular option. So the next scenario they looked at was if somebody bought an RPI-linked annuity. So it was like the level annuity scenario, but your income was increasing at 3.5% each year, so protecting that purchasing power of your money. Now, if you buy an inflation-linked annuity, the initial amount you get is lower than if you buy a level annuity. So in the same example they gave, they had a £150,000 pension pot, would get a lower income initially at age 65 of £6,565, but it increases each year by that 3.5% assumption, as I mentioned. So that means in year 2, you get £7,797, and so on and so on. It means that the total income that person would receive by age 90, based on the scenario that they've created and the calculations, that total amount was £255,706. Now, the downside, of course, is the initial annuity rate is lower than the level rate. And the other downside, of course, is that you've paid your pension money across for that annuity and you've lost access to that money. So the third scenario is the phased annuitization with drawdown. So instead of buying a single annuity at the start at age 65, instead they looked at the scenario where you bought a level annuity in phases and you keep the rest of the money that you haven't used to buy an annuity in drawdown. So in Standard Life's example, what they did is they assumed that at age 65 the person bought a level annuity using £90,000 of that £150,000 pot. Then every 5 years thereafter, they used another £20,000 to buy another new level annuity. And the remainder of all the money was kept in drawdown, and they assumed a 5% annual investment return and a yearly income derived from that drawdown of 3%. Now, if you look at the analysis, it indicates that this strategy could potentially provide a total income of £259,115 by age 90, which is higher than both of the single annuity options that I've mentioned earlier. But furthermore, the annual income in this scenario starts at £8,155 at age 65 and gradually rises to £12,065 by the time you reach age 80. Now, this combined approach gives flexibility, and you still got money in drawdown, which you could theoretically pass on to the next of kin. I won't get into the IHT treatment of that because things are changing with regard to drawdown. But more importantly, it gives you the ability to benefit from the rise in annuity rates as you get older. So each subsequent purchase of an annuity, you're getting a better annuity rate, assuming that obviously annuity rates don't suddenly crash because gilt yields do. So that shows you, by using a combination of annuitization over a period of time with drawdown, you have the potential of securing a greater income. And the other thing is, there is the flexibility that if your scenario changes and you need to access that drawdown pot for whatever reason, then you can do it. So the point is that there are solutions out there that can match our retirement. Because if you think about it, a lot of people now, retirement isn't a sudden stopping point. For people, it's a gradual transition. They may change careers, they might change hours, start working reduced hours. But that flexibility does require a bit of a more nuanced approach to managing pensions. So annuities are an important part of maximising retirement income, and there are plenty of options with them. So, for example, you've got fixed term annuities that can help bridge an income gap between retirement and maybe when your state pension begins. But you've also got enhanced annuities that I've talked about in other videos, where you can get a better annuity rate because maybe you've got a health issue, or maybe you're just a smoker. And there are drawbacks, of course, to annuities that I've talked about. But ultimately, what I want people to take away, that a combination approach to retirement is something that you should consider. And it's not an either or decision. But more importantly, make sure you speak to a financial advisor, because a good financial advisor can go through all of these options and build a plan for you. Now, if you don't know a financial advisor that you trust, then there is an article on the Money to the Masses website, which there is a link to in the notes of this video, which will show you how you can find one using the various resources out there.
Okay, so let's move on to the final piece of the podcast then. And we're going to be talking about energy, but it is a slightly different piece this week. Now, we've talked previously on the podcast about predictions on energy prices, looking at that energy price cap, which is set by Ofgem. We've talked about a company called Cornwall Insight, and what they do is they use algorithms and analysis in order to work out their best predictions on where those energy price cap figures are going to be in the future. But there is a new way now that we can start to look through these numbers ourselves on a weekly basis and really get a good snapshot as to where these energy prices are going to be. So there are 3 major energy providers now that do regular updates on their website in terms of the predictions on where the energy price cap will be. And the companies are E.ON Next, EDF and British Gas. And I'll put links to all of those in the show notes of this podcast. And the reason we now have these additional numbers at our disposal is Ofgem set the energy price cap based on the wholesale price of energy. Now, of course, energy providers are paying that wholesale price. And so by analysing those numbers and using the rough algorithms that Ofgem use, they can come up with a price which is going to be pretty close to what the Ofgem energy price cap will be. Now, the price cap is set every quarter, and actually on the 25th of February, we're going to know the exact numbers for April. We're now in the middle of February, so the numbers that they're coming up with for the April energy price cap are going to be pretty close to what the actual energy price cap numbers will be. So just to give you those numbers out there, British Gas are saying that come April the 1st, the energy price cap is going to increase to £1,830. Just a reminder, we're currently at £1,738, so roughly £100 increase. If we look at what EDF are saying, EDF are predicting an increase to £1,859 come April, and E.ON Next are predicting that the price will go to £1,838, which is bang on £100 increase for the April price cap. So the message is that you really need to consider fixing if you haven't already, because we know from the predictions that the energy price cap is going up. We're looking at a roughly £100 per year increase for the average dual fuel household. But when you look at the deals that are on offer at the moment, the current fixed deals, you can actually get some deals that are around 5% or so cheaper than the current energy price cap figures for January. So when you combine the potential increases, plus you can make savings on the current one, you could be looking at around about a 10% saving, which is anything up to around about £200 on your annual energy bill.
So if you haven't fixed your energy bill, then you've not missed the boat, because unfortunately it looks like the energy prices and that price cap, which most people are paying if you haven't fixed, that is going to go up. And as Andy says, the deals out there are pretty decent, but they're going to look even better compared to where the price cap might be headed. And don't forget, once we know where the price cap is going to be headed, the deals are going to probably change and disappear. So it's definitely one of your homeworks for this weekend to look at if you've not fixed your energy bill already. So Andy, that is a great way to end the show this week. As ever, do make sure you follow us on all our social channels. I'm talking about Instagram and TikTok. Join our Facebook group, facebook.com/groups/money to the masses. Now, there is lots of stuff we're doing on socials that we don't ever do on the podcast. Make sure as well, I need to tell you guys to do this more frequently. Do subscribe to our weekly newsletter. So you go to moneytothemmasses.com/weekly-newsletter, and we push out a newsletter by email every Sunday at 10 a.m. with all the main stories that are affecting your finances. So do make sure you sign up to that. And there's also deals and etc. that are included in that particular email. Obviously, go to YouTube, subscribe to our channel, and comment and like at all of our videos, because that does really help us. And of course, if you want to give us a 5-star review, whether it's on Spotify or Apple Podcasts or whichever app you use to listen to the show, then please do. And do also tell us, because we like to read them out, and every now and then we do give away a Money to the Masses mug. So that's it, Andy. I think all that's left for me to do is say until next time.
Until next time.
Whoa.